Well, it looks like banks are in trouble yet again. And this time it's a big systemically important bank, not one of those smaller systemically important banks. This time it's Bank of America showing over $100 billion worth of unrealized losses. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. Now, it's been a minute since we've talked about banks that are in trouble, and so I'm going to explain the background on this and how bonds work so that you are crystal clear about exactly what is the problem and what is not the problem with banks like Bank of America today. If you've heard me explain this a dozen times, skip forward. When you give $1 to the bank as a deposit, the bank has to do something with that dollar in order to make money. They just held on to that dollar. They would have no way to make money off of it. They'd shut their doors unless they charge you fees just for holding on to your money. And today people don't like doing that. So they take your dollar and they go invest it so they can make a profit with your dollar. The main thing that banks buy, that they invest in with your dollars, is bonds. But over the last year or so, the value of bonds have fallen dramatically. This means banks all over the country and all over the world are sitting on a massive pile of losses right now. But why is it that those bonds have fallen in price? Well, it comes down to the way that bonds work and the fact that interest rates are being pushed up by central banks all around the world right now. So let's say I borrow $100 from you at 1% interest rate. That means in 1 year, I'm going to owe you the $100 back plus $1. And the reason why I'm able to borrow from you at 1% is because that's the going rate. That's what everybody is paying for debt right now. So if you wanted to loan your money to somebody else instead of me, everybody is doing 1% right now. There's lots of borrowers and lots of lenders. And so if you want to be a lender, you're going to have to lend it at a 1%. Because if you go to somebody else and say you want to lend it at 2%, they'll say no because they're just going to borrow it from somebody else at 1%. So you go along with the market, you loan that $100 to me at 1%. But then overnight, something changes. Somebody out there in the market says that they are willing to borrow at 5%. And not only is this new player willing to borrow at 5%, they have an unlimited amount of money to do so. Now you're sitting there and thinking, man, if I would have just waited instead of lending out my money at 1%, I could have lent my money out at 5%. And that's true, but you're in a little bit of a worse situation than even just regret, because that loan that you made to me at 1% is now worth less. And here's how. Let's say something happens to you tomorrow after interest rates have gone up to 5% and you owe somebody else money. An unexpected bill comes up, something happens, and you need to access money that you don't have. Well, you know that I owe you money back. And as long as you just wait a year, you're gonna get your $100 plus your 1% interest back. But you can't wait a year. You need the money now. And so you have to go to somebody else and say, hey, can I sell you this debt so that now I will owe that person $101 instead of owing you $101. Now, there's constantly people borrowing and lending to and from each other. And so there's gonna be somebody out there who's gonna be willing to buy this debt so that I owe them $101 instead of you. But remember, the going interest rate right now is 5%, not 1%. So they're not going to pay you $100 for this loan. They're only going to pay you $96 for this loan, because they could take $96 and loan it out to anybody at 5% and get $101 back. They're not going to give you a deal. They're going to give you the exact same deal as what the market is offering right now. They're going to pay you $96, and then I'm going to go them $101, and they're still going to get their 5%. But you loaned out $100, and now that you sell that loan, you're only getting $96 back. So that's the relationship between interest rates and bond prices, and why when interest rates rise, it makes the value of the existing bonds go down. And that dynamic that I just described is exactly what has happened to every single bank out there. During 2020 and 2021, they loaded up, loaned out a ton of money at rock bottom interest rates. In early 2020, when the Federal Reserve lowered interest rates, even the 10-year government bond was trading well under 1% for a very long time. Not to mention debt like 2-year bonds that were trading at 0.25% or lower. This means everyone right now is sitting on massive losses. All these banks that got a bunch of money and loaned it out at low interest rates are a lot higher now. So all the bonds that they own are worth a lot less. As of right now, total banking industry unrealized losses are sitting around $500 billion, which is much better than it was a couple of months ago, but still extremely steep historically speaking. And as a report by the Kobesi letter shows, Bank of America is by far in the worst situation. Highlighted on the right, we see the unrealized losses starting at the bottom with Chase at $36 billion, Citibank at $24 billion, Morgan Stanley at $9 billion, Wells Fargo at $41 billion, which if you're still banking with Wells Fargo these days, you must hate yourself. And at the top of the list with the most unrealized losses by a massive margin, we have Bank of America at $108 billion of losses. So the exact same thing that I described in our little illustration, Bank of America did. They got a bunch of dollars in deposits during 2020, 2021. They loaned them out at rock bottom interest rates. Bank of America received about $670 billion in deposits. And now that interest rates are moving higher, all of those bonds that they purchased are at massive losses. Now, it's key to note that with the collapse of banks like Signature Bank and Silicon Valley Bank and First Republic, they were forced to sell these loans because they took dollars from depositors, purchased these investments, the investments went down in value, then the depositors wanted their money back. The bank had to sell those assets to produce the dollars to give the deposits back, but the investments weren't worth enough in order to redeem all those deposits. So these banks that failed never planned on selling those assets. They were forced to because of a bank run. Now, the likelihood of a bank run happening with Bank of America after the Federal Reserve's intervention to bail out the depositors of the last couple banks is very unlikely, but the chances are not zero. If too many people who have their money at Bank of America right now get spooked and say, no, I'd rather have my money at Chase, because Chase, a much larger bank, has only $36 billion in unrealized losses, or they want to move their money to something like a money market fund so they can have a much higher yield. There is a risk that Bank of America will be forced to sell some of these assets at a loss, and those unrealized paper losses then turn into realized losses. Now, Bank of America is absolutely considered too big to fail. It is a GSIB, a globally systemically important bank. And as Zoltan Pozar pointed out in a recent interview with Bloomberg, the BTFP is part of the system now. It is a standard feature. Remember, the BTFP is the Bank Term Funding Program. The Bank Term Funding Program offers cash to banks in exchange for US Treasuries. So when banks come under stress, instead of having to unload those assets that are at a loss on the market, they can just give them temporarily to the Federal Reserve in exchange for a much larger amount of cash. Usage of this facility is what caused the Federal Reserve's balance sheet to spike in March of this year. So we know that Bank of America is not going to be allowed to fail. They'll unload these toxic assets, which are really just government treasuries, to the Federal Reserve, at least temporarily. But this is evidence of more rot in the system than people are aware of. The entire structure is shifting right now and is becoming more and more unstable by the day. Number one, everyone has losses. This is not just Bank of America, this is every single bank. While the big ones have big numbers, you can see that that every single bank has a large red number right now. Number two, the biggest players in the world in the bond markets are all sellers right now, and this has never been true before in history. The tick data on treasury.gov shows all of the foreign holders of US treasuries and how from January of 2022 through January of 2023, central banks around the world were net sellers. And the biggest ones like Japan and China sold the most. It used to be in the past that central banks around the world were buying US government debt, loaning dollars to our US government. That's no longer the case. They're selling this debt now. The Federal Reserve is no longer buying new US Treasury debt. They're letting these assets bleed off their balance sheet. And the US Treasury right now is going on a borrowing binge, borrowing hundreds of billions of dollars to refill its coffers and to fund its ballooning expenses, which means that all of those banks that are sitting on losses are sitting on a ticking time bomb of those losses getting even worse because there's nobody buying these bonds to push that pressure back up. Everybody who is historically the biggest buyer is selling. Obviously, this is crushing the banking system, and it comes at a time when central bank digital currencies are being pushed, more regulations are being pushed in order to try and stop what banks can do in order to make money and force them to do other things. These are all incremental steps to nationalizing banking in the United States. It may not be tomorrow, but at some point, if we continue along this trend, banks will not be able to survive as private profitable entities. They'll all be folded underneath the Federal Reserve or the Treasury, and we will have a unified nationalized banking system. There will be too many regulations for them to do anything to profit on their own, and they will be too subsidized by the government for public opinion to be okay with them making money on these services. And due to digital currencies, Bitcoin, cryptocurrencies, and the general rise of CBDCs around the world, it seems like only a matter of time before the competition builds up and we get a digital dollar, which displaces the need for the banking system other than to be piping, the plumbing in the system for the Fed. So yes, there are big losses at big banks right now. Without intervention, they'd be a big problem for these banks, but we know the intervention will happen, the banks will be saved, but ultimately it will cost people more in the end when banks are just part of the government. And finally, if you'd like to learn everything you need to know about money in order to protect yourself from crazy stuff like this happening in the future, whether it's dollar devaluation, asset confiscation, stock market crashes, inflation or deflation, or anything else, you need to sign up for Heresy Financial University. It's my membership program where I teach you everything you need to know about money. You get access to every single masterclass and course that I put out, every single one that I have out currently, and every future course as a member of Heresy Financial University. Advanced investing strategies, asset protection, hedging, fundamental analysis, basic things like getting out of debt, budgeting properly, retirement accounts, and more. Sign up with the link in the description below. As always, thanks so much for watching. Have a great day.